From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, June 12th. This is Tony Fratto coming to you from Western Pennsylvania this week. John Fagan, Brendan Walsh, our partners from Markets Policy Partners. This is the HPS Macrocast. And guys, a massive sell-off yesterday. I think, last week we were talking about the, what is it that markets see, after this really long, run-up over the previous 30 days or so. And, what is it that the market participants are seeing in this economy that we're not seeing, and we had lots of explanations for it. Well, it seemed like they woke up this week and said, oh my God, we're in a pandemic. and it's not necessarily, it's getting a little bit better. It's not going to be as good as it was. And yesterday, over 1,800 points in the Dow, massive, 6-7% declines in equity markets. A little bit of coming back today, but what did you see on that on the move this week, and especially yesterday?
Yeah, thanks, Tony. It was certainly very abrupt, and I think the whenever you see a move like that in U.S. stock markets, the S&P 500 was down a whopping 5.9%. The usual outperformance we see among the big tech stocks didn't materialize. The Nasdaq was down 5.3%, and so you're going to be getting a search for culprits, right? Who are the suspects in this sell-off, and what precipitated it now? As you mentioned, there was always among the skeptical quarter of the skeptical crew wondering why it was up there in the first place. I mean, the S&P 500 was flat for the year on Monday. It erased all of its 2020 downside as of its rally on Monday, and the Nasdaq reached a record high on Wednesday and crossed 10,000 for the first time. This is just an incredible bungee jump snapback, and so that's really, if you're looking for suspects, that's kind of one of the first, which is this market had been overdue for a pullback. This just dizzying and breathless run higher is going to exhaust buying activity. There's always a need for a pause, and so there's certainly analysts and market commentators pointing at the need for a technical pullback, and this was a necessary thing to clear the air.
Well, the president identified his culprits.
It's
like round up the usual suspects, and the president and Larry Kudlow said, get Powell in here.
Yeah, right. They exactly as you said. They rounded up the usual suspects, pointing the fingers at the Fed. Larry Kudlow snarked that Powell should smile more during some of these media appearances.
Be upbeat. Always look on the bright side of life.
Right. I mean, the difficulty there is, as plenty of analysts have pointed out, is if the Fed's going to be upbeat, that means they're not going to be easing as much. Yeah. And of course, the White House wants them to be upbeat about the economy, but still easing, which isn't necessarily in the cards for a rational Fed. But certainly the other. Jay Powell's performance at the press conference that followed Wednesday's decision was said, but it didn't lift asset prices, but really it was from our view,
job,
it was totally
right?
Yeah, it was also totally consistent with the tone and the focus on downside risks that he has had for months, that all of his colleagues have expressed for months. There's really nothing different other than the degree of specificity with which they put the magnitude of those concerns, because this meeting was where they published the updated estimates for future growth, and they were certainly pretty dire, but it was, again, totally in keeping with what the Fed has said, and none of their policy pronouncements were particularly shocking. So it's a little bit hard to make that case stick. The other one, I think, which we're sympathetic to, is the fact that the markets have been warily monitoring the uptick in coronavirus infection cases in some of the states that have had an accelerated or sort of early reopening, or that are further down the line in some cases. We've seen Texas, Arizona, Nashville announced that they were going to be delaying another third phase of their reopening because of an increase in cases. Houston is a hot spot.
Houston's a hot spot. California's up. North Carolina, South Carolina.
And it's worrisome, and there are kind of some splitting hairs. Larry Kudlow was out this morning saying this is not a secondary spike. And, technically it's not a secondary spike in a lot of these places because they didn't have that first spike.
First wave. Yeah.
Right.
Yeah. Scott Gottlieb said the same. Scott Gottlieb's point on this, former FDA commissioner and really, straight talking commentator on coronavirus, has been really good on TV and writing about what's going on and explaining things for a lot of people. His point was, don't call it a second wave. This is like, for a lot of these places, it's a first wave, or the wave has never stopped. It's been a continuous wave, and to his point, that a lot of these places reopened, ignoring the, not just the CDC guidance, even the White House guidance. White House did put out guidance on, under these conditions, 2 weeks of 50% decline, and are conditions for reopening. You don't have those in the places that didn't have that first wave. And what's really unfortunate is that, these places had months and months to prepare to avoid these kinds of spikes. That's the really unfortunate thing, is that they could look at what was happening in Washington State and New York and other places and say, we're not going to let that be us. We're going to do the things to prevent that from happening. And it doesn't appear that they use that time very well.
I wonder how much that was in the Powell's and the Fed's thinking of being exceptionally dour in terms of their outlook, because what we've seen the Fed can do is limited in terms of reaching down to Main Street. QE can help the stock market and we can lower rates, but if you don't have a job, getting a cheap mortgage isn't going to particularly help you. And everything that Powell has said is he's very concerned about the high unemployment rate, especially at the lowest levels of our economy, where now we've talked about it, the market's up, and there's this sentiment that we're just going to reopen, everything will be fine amongst a lot of the nation, but also especially down here on Capitol Hill. And I think Powell realizes that the only way, his policy tools are limited at this point. Now we need to turn it over to the fiscal, and we need that the fourth stimulus package, maybe a fifth. But if the narrative is that we're going back to a V-shaped recovery, COVID is over, that's a thing of the past, a lot of people down here might think that there's no need for more stimulus.
Well, we've certainly seen, we've seen the equity markets validating an optimistic view, but certainly, and we'll talk about this later in the show, the non-farm payrolls for May that came out last Friday, certainly were another leg of support for that particular viewpoint. But when we talked, we did a call yesterday with our friend Dr. Christopher Moores, who's the director of the public health school at George Washington University's virology unit, and he's very close to this. And we hosted him on the podcast, a special edition of the podcast, very early in the in this COVID outbreak. And he's still very focused on the unknowns about this. They know it's wildly transmissible, but there's still a lot of things they don't know. And just how you can have a situation in which a case that they saw, which is 2 hairdressers were positive for COVID. They cut the hair of 140 people and none of them have tested positive. But in other cases, you get this community spread, which is obviously pretty clear. We've seen the headlines reporting that National Guardsmen who'd been mobilized to deal with the protests over the past week, they've been testing. A number of them have been testing positive. We've seen these mass gatherings. There's still just a lot of uncertainty, and when National Economic Council Director Kudlow says that we can't shut down the economy again, and Treasury Secretary Mnuchin says we can't shut down the economy again, and President Trump echoing President Trump in that, that's obviously hortatory. They don't have necessarily the power to make state, local, and governors of states do that and follow their direction. But they point to the greater understanding we have of this virus and how it's transmitted, and just how we can manage these risks. The reality is, we don't have the kind of testing that we need in the U.S. We don't have the contact tracing that they have in other places. It's patchwork at best, and it's a work in progress, even in places where it has advanced. Yeah. And there's no unified approach. It's a really case by case, state by state, even city by city approach to it. And there's still just a lot we don't know about this virus and how it transmits. And so we're taking a leap of faith here in reopening, and it's a really delicate balance.
Yeah, and on top of that, we want to remember. So the testing is, people have always questioned about testing, right? And it's like, well, we would have known where these hotspots were early on if we had sufficient mass testing. I think that's clear. A second point on this is that, whether governments are making decisions to shut down or not shut down, at the end of the day, consumers are making the decision on when to shut down. The government didn't shut down the economy. The NBA shut down the economy, right? When the NBA said, we can't expose our players and our fans to this virus, it's in our, probably ethical and legal interest to stop play. And everybody, lots of other people, and they were the only ones, right? There were others who said, so it was like people stopped going to restaurants, they stopped going to big events, they, had legitimate fears, and consumers stopped being economic actors for lots of really good reasons. The third point I would make on this is that we are not an island, right? This is a global, pandemic is pan, it's across the world. And we are seeing, while we're seeing spikes in hotspots in the United States, we are seeing rapid increases in places like India, Brazil. Now we shut down, travel with Brazil. We haven't shut down travel with India. We've shut down travel with Chinese nationals. We've done, limited travel with Europe. Are we going to do this with the entire globe as this spreads to other parts of the world? What does that do for global supply chains? And bringing us back to, the question on markets on all of this is that we could have made a case, right? You could make a case a week ago, like where the markets are, like they probably don't belong in, record territory again. But you could say that, like, if you're optimistic that we're going to come back, and you understand there's some enthusiasm about that, but let's say we're going to be at 75% of what would otherwise be normal economic activity if all things go well. Plus, we have the Fed out there with massive easing and a big fiscal response. So discounting, what future earnings look like just got a lot better because of Fed activity, support from fiscal authorities. Okay, you can make that case. I would still argue that, being at 60 to 70% of normal economic activity shouldn't, with no idea when we're going to return to 100%, plus the growth that we need, right? We should be thinking about in future years, 110%, right? 110% of economic activity. So I still think it was irrational exuberance there, but you can make a case of some comeback in it. But it's got to be lower. It can't be higher, it's not where this isn't where equity markets should be. So I'll put the question though to you guys is, where do we go from here? We had a big sell-off. It's a down week, erased a lot of these gains. Where do you think it goes? Was this a wake up for the market? Are they reassessing the world around them, or is this a pause?
Yeah, I think if you accept the premise that there was a real fundamental underpinning of this rally where stocks were running up on the expectation that we were going to get a pretty smooth reopening, I think that it's hard to say that the equity markets are going to have an easy time to achieve more upside here, because clearly we're seeing evidence that reopening is it's a challenge. It's nuanced. It's difficult. People are going to be risk averse in this environment when they see hotspots, but they don't know. They see the evidence of hotspots, but they don't know where they're occurring. Just as you said, Tony, it's a real process getting consumers comfortable with the kind of economic activity that they were used to pre-pandemic. And I think the data that we're seeing is proof positive that this is a really challenging and tricky virus, which is something the public health community has been telling us. And even if we don't go back into lockdown on a national scale or even on a major scale, it's still really standing the gears. But, there's also the case that this market run up has been premised not necessarily so much on, just a sense of optimism on recovery, but it's just been a massive tailwind of Fed liquidity and speculative activity. And if you think that this is a market that is just enthralled to the Fed's monstrous QE program, where they've dumped trillions into the fiscal stimulus as well alongside of it.
Yeah.
And if you think that it's just, if it's basically just a, zero interest rates and monstrous, infusion straight to the vein of QE that lifts asset prices, that's what QE does, then, what's to stop this market from turning right back? And we see, Dow futures are up 600 points this morning. Exactly. And everybody's Amazon's on sale. They just sold off, 5%, and I gotta scoop it up.
We're coming to a fiscal cliff in July, where the extra $600 is ending. The moratorium on evicting renters is ending. So there's a lot of things that have actually been hugely stimulative for the broader economy. A lot of people, from the data we've seen from Chase and Bank of America, 30-40% of people actually end up making more on unemployment benefits than they did by staying at home. It seems like that's going to end. So default rates could go up. So people, I think, are not paying. They assume that the static relationship between the economy today and the one that we're going to see in August is the exact same. Where even if everyone just went back to work, some people might actually be making less money, and also now you also have to go do commuting and things like that. So there might be actually less money to spend in the second half of the year than there was in these 3 months on the lockdown. So
why don't we come back and talk about that and talk a little bit about what the Fed is and isn't doing? And I think Chairman Powell addressed that a little bit this week at his FOMC press conference. So why don't we take a break, and you're listening to the Macrocast, and we'll be right back.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com or visit them on Twitter @marketspolicy.
All right, we're back on the Macrocast. Guys, ordinarily, you have an FOMC meeting, and we talk about what all went into the Fed's thinking on what the decision they made on rates. But of course, they made the decision on rates that no one should be surprised that they're going to make. Rates remain near zero, unchanged, and for as long as the eye can see. What he did get a chance to talk about a little bit was all the other things that the Fed is doing, and number of Fed programs to supply support for the economy. Main Street lending program is one of them. We don't usually talk about the Fed in terms of it's sort of direct support, but it's what it's found itself having to do in this situation. We're still waiting for the Main Street lending program to make its first loan. We've talked a lot about PPP. Brendan, how are you seeing how what the Fed is doing with these programs and how they're responding?
So it's clear that they're very concerned, and I think the Main Street lending is a perfect example where they put it out there and no one's tapped it. So even before they're making their first loan, they're kind of expanding the broad range of businesses that can borrow from it. I'm not sure that that's even going to work, because quite honestly, a lot of these businesses can get a better loan just from their bank than the Main Street lending. So I think that's one. If you're going to really make a big difference, you need to change the terms of the loans rather than who is it eligible for.
Yeah.
but also on the municipal side, where we've seen a few states and municipalities start, or at least begin the process of taking loans from that. That one could be huge, but in the end, that program is not going to be enough to fill the holes that are being filled across the nation, or they're being created across the nation for at the state and local. When people don't go outside, you don't charge them, tax on their meals or their ice skates. So that's going to have to come at the fiscal side, and that's why I think the Fed was their outlook. I don't think it was dour. I just think it was honest and be like, this thing's going to take a long time for us to get out of. So we're going to be on hold for a long time. And I think one thing that maybe this came up in the conversation, the Q&A, but John and I have talked about it for a while, and something that the Bank of Japan does is controlling the yield curve. And when that question came up and Powell said that it is a possibility, the market took that very bad. Banks sold off a huge amount on that. But I don't know why it was such a huge surprise. When we're at this point in the cycle, there's not much else you can do. What do you think about the yield curve, John?
Yeah, I mean, I think yield curve control is, my own personal view, having watched the Bank of Japan do it, is it's obviously a closer coordination. It seems to be closer coordination with the Treasury Department. Yeah. Really is one of the main. Basically, it's putting quantitative easing on cruise control, and quantitative easing is about a certain number of bonds that that the Federal Reserve buys as a formulaic aspect of additional easing once you get to the zero lower bound on interest rates. So then they start taking, one of the ways they measure it is they take 10-year equivalent duration of Treasury yields out of the market. And so if they take that out of the market, then people that would otherwise be owning those 10-year Treasuries are chased out the risk curve. They buy AAA bonds, and the people that would have bought AAA bonds then go buy AA bonds, and down the line until you get a situation where investors are forced to bid up the price of risk assets, or pushed to bid up the price of risk assets, and that's how QE works. But they've just bought so much. I mean, they've expanded the balance sheet so massively that it's, they've got to somehow taper this without, sending the market into withdrawal. And that's one of the things that we saw that the Bank of Japan was able to do through yield curve control. They said, wait, okay, we're not going to buy a specific amount. We're not going to commit ourselves to buying a specific amount of government bonds. We're going to basically target a rate on the 10-year yield. That's what the Japanese central bank does, with a corridor on both sides, and say we're going to buy as much or as little. We're going to have a basic kind of expectation of how many government bonds we're going to buy, but we're going to increase or decrease that depending on whether we need it or not to hit our target. So it allows the Fed to kind of ease off their parabolic increase in the balance sheet without perhaps saying, and labeling it a taper. But, where's the juice in yield curve control? Right now, I mean, the yield curve looks pretty controlled to me. 10-year Treasury yields. Range. Yeah. We had this huge blowout number, 10-year Treasury yields. It didn't even make 1%, and they've fallen straight back down. I think they were 70 basis points this morning. And the Fed, when the reports coming out about how they're going to institute yield curve control, they're talking about controlling the front end, or they're not maybe brave enough to go out to the 10-year yield. And so controlling the front end, what's the difference between stern guidance or solid guidance and yield curve control?
Right.
It just doesn't seem like there's a lot of juice in that policy. And they're also talking about, this is stuff that's like, if you're talking to the man on the street, right? Someone who is lower middle class and is having a tough time in the economy, the translation of yield curve control into helping that person is so remote. Yeah. And it's just so circuitous that, you start to look at the other side of the Fed's programs, like Brendan alluded to. Main Street lending has just been dead in the water right now. They can't seem to get the formula right. Maybe it'll take off. But things like that are at least, a direct line into people's, retention of employees. I think the municipal lending, the fact that, Illinois, which is having big problems raising money from private sources in the muni bond market, is set to basically take that money from the Fed at a full point lower than they would have been able to get from the markets. The MTA, they changed the program so that the New York's Metropolitan Transit Authority is going to be in line for getting some Fed funding, some concessionary loans from the Feds. That's real people with real jobs getting, being able to be retained by and do economic activity that they otherwise might not do. And this is a there are a lot of questions about the Fed's kind of quasi-fiscal role, and they're expanding. But this is
what the Fed can do is credit, though, right? And so they are allocating credit, and so that it is quasi, right? It does definitely. Yeah. It's at least straddling the line. There's no doubt about that. But that said, there are also questions about the effectiveness of it too. Like we think about MTA, New York Municipal or Metropolitan Transit Authority. Who knows where it's going to get, when it's going to get to ridership levels that return it to being a going concern. And a lot of these, whether it's the state of Illinois and a lot of other states and municipalities, it's not like they had a lot of overhead in borrowing capacity that made sense for them. Otherwise, they would have been borrowing already at those levels because they have big needs, right? So the ceiling for borrowing for them is constrained. The concessionary terms that the Fed has for them has given some more ceiling for them to borrow, but it's not unlimited, and it's nowhere, it's not a long-term solution. And we have to remember that even at concessionary levels, there's interest on the debt that needs to be paid back, and it's a drag on future growth for everyone who is, taking more, because it's not like these are going into investments that are going to elevate productivity and then return on capital. These are literally to keep people on their jobs and keep the lights running and keeping the tracks maintained and the trains maintained and those kinds of things. So it's not adding to future growth. It's still subtracting from future growth, and that's a concern. I'm not arguing against it. I'd rather us see do more of it. I'd rather us see do a lot more of it in the form of grants, recognizing that these are going to be drags on future growth. But that's the reality of it, and so these are good things to do. They're the right thing to do. They're not panaceas for what we're facing right now.
Yeah, it would be great to have a panacea. Hopefully, that's
a vaccine will do.
The equity markets
be a big step.
Yeah, the equity markets.
Which,
have been
by the
acting
way,
like they've got a vaccine lottery ticket in their back pocket.
We should note, and we'll do this, and we'll take another break. But the work that these companies are doing to get to a vaccine as quickly as possible. If you don't know anything about the business of developing, testing, improving vaccines for the market, what is going on here is pretty heroic. And I know that, yes, some people are going to make money on developing the vaccine. I understand why there's a race and there's good incentives, there's financial incentives to getting this done. I will still say the time frame that they've condensed for the development, testing, and distribution of a vaccine as soon as we have one, it's pretty impressive, and it's a story in itself. And usually these things can take, we're talking about maybe in months, some level of months or a year that we have a vaccine, and then we'll have lots of other ethical problems on how to distribute it. But relative to the usual years it takes to develop one and then distribute it, it's really impressive. So why don't we take a break there and come back, and let's close out talking about that still confounding jobs report. Maybe it's a little less confounding today, but let's take a break and come back on the HBS Macrocast.
Check out HPS Insights, a regular podcast from Hamilton Place Strategies, bringing you the latest on policy debates affecting the business and political communities. Available on your favorite streaming platforms, including Apple, Spotify, and Google. Tune in to the latest episodes and learn more at hamiltonplacestrategies.com/podcast.
Okay, we're back on the Macrocast. Guys, I was just thinking, like, I barely even said anything last week because I think I was just like dumbfounded by that jobs report. Thank goodness Matt McDonald was here to do his on the spot analysis of it. There was just so much in there and so much to try to sort out. We've had a week to sort out some of it, and there was, if you're on economics Twitter, which is like, let's be honest, it's the best Twitter. It's the best. It's like, I mean, and when I say that, I mean, not because it's not entertainment Twitter, but it is the most educational Twitter. Like some of the people who are on, economics Twitter, following things like the non-farm payrolls report and GDP and others, they're not just really smart, they're also really good at diving in and trying to explain and educate for us and each other. And it's really impressive, just like really, really good. What dominated talk well into the weekend and even into Monday morning of what exactly went on with we talk about miscalculation of jobs or misallocation of people's condition, what that meant for the rate and job creation. And Brendan, you had a little time to dive into it. How do you explain what happened in the jobs report?
Right. So especially with the unemployment rate, the BLS gave a special note, and they said a lot of it, the fact that it was 13.3 wasn't really true. It had to do with the way people classify themselves. So essentially, if you're on furlough and you expect to go back to your work once your restaurant opens, you weren't considered unemployed. So the reality is it would have been 3% higher. So the real unemployment rate judged by the U6 for the BLS is 16.1%. And then on the employment report, so that survey comes from calling people on the phone and asking them questions. The number of jobs that are created, that comes directly from employment, from companies. And so everybody had to lay off a bunch of people because we had to shut down the economy. So then we're at zero every month, essentially, So when you didn't have to lay off anybody else, every person that was able to come back to work is a positive. But I think definitely the rules of the PPP played a role in that 2.5 million. We don't know exactly what it is, but people were worried.
Which is a good thing.
Which is a very good thing, yeah. It brought them back. Since then, actually, Congress has kind of amended those laws to make it a little more less onerous, that if everybody doesn't come back, you don't have to pay off the whole loan. So again, I think every month we're going to have, going forward, the number of jobs created are going to be somewhere between like 0 or 1 million. And it's almost impossible to predict what exactly it is because it's so dependent on, are people comfortable to go out to dinner? Are people going to go to gyms? Things like that.
But especially about this classification problem, right?
Yes.
And the point is, like, if you're saying, are you, are you looking for work? Are you unemployed without, what is your, you answer the question about what your employment situation is, and people answer that question sometimes in different ways. And if everyone, we're still using the questions of a time period. Yes. That was normal, and we're in an abnormal period. I think one other thing on this too is, like, it's, when we're back in normal times, and so job losses on any given week are, as we saw, like with our initial weekly claims are,
it used to be 200.
We're hovering around 200,000 a week.
Yeah.
Right. Like, so 200,000 a week, pretty steady. Like when you're in the normal ranges of economic activity, and you make you have expectations on those things, you can be off by a little bit, but it's like the bigger the numbers get, the bigger the variance in mistakes that you can make, right? So the little mistake where it's someone asks you, what were jobs going to be in February, and your prediction is 250,000 jobs, net new jobs in February, and it's actually 295,000 jobs. That's a small miss,
Yeah.
in a sample like that. You when you start talking about millions of jobs, right? That same range of miss is like, so the numbers are much bigger, and so it just gets really hard. Even in this, I always say this, like, this is the greatest data collection country in the history of mankind, right? Like, I mean, they've had like smaller, some places have done like good data in the Roman times. They counted everything, and you can go back and actually look at this stuff. But it was like much smaller, smaller numbers of people, smaller things to count. In an economy with 330 million people, scores of millions of jobs, of businesses, spread out over a lot of municipalities. Like, there's so many things to count, and you think of like the guys who do the GDP, who do BLS, Bureau of Labor Statistics assessments. It's the best there is going in the world. That said, you're going to have these kinds of variances because they're really big and it's really hard to do.
No, it's a great point. I mean, and that's why one of the reasons we're looking at the weekly jobless claims and the continuing claims. Yeah. And those are not a survey. Those are real. There are distortions clearly because some states are behind and they have rickety reporting apparatus and so forth. But those are telling a story that makes sense, which is not a frantic sprint of rehiring or a burst of it's a relatively steady improvement. But obviously we're still in pretty dire straits in the labor market. We all hope that we continue to improve. But
John, that's an important point. So initial claims now, that's telling you, okay, I got laid off and then I filed for it. Continuing claims, every decrease in continuing claims shows, for the most part, that person went back to work. So in the last couple of weeks, and continuing claims is from last week. Initial claims is from a week. It has a week lag. Continuing claims has a 2-week lag. But right now, as of 2 weeks ago, about 20 million people are on continuing claims. So I think that gives you a halfway decent sense of really what the amount of unemployment in the United States is.
Yeah. We have some data coming up next week, though. So what are we looking at for next week?
Right. So we get the May data. So we get retail sales in the United States and also industrial production. Those are retail sales outside of the employment is probably the most important data point that moves markets. And industrial production, obviously, is very important also. And then on the monetary policy front, we have the Bank of Japan and then the Bank of England, which I don't think it's going to happen at next week's meeting, but there is there's some talk on Wall Street that maybe at the August meeting, the Bank of England could cut to 0.
Yeah, Bank of England looking at like hard Brexit, the worst COVID outcomes in Europe, and it's not a pretty picture. That Brexit deadline is there on December 31st, just when public health officials are speculating that we may be involved in that secondary spike. It's not a pretty picture, and it'd be sensible, to think that the BOE would want to get out ahead of that as much as they possibly can.
Yeah, I think they have to. It is a real mess, and a confluence of messes that they're dealing with there. And there are reports now that there were these reports in the UK about having hard border checks on everything. There's still this delusion in the UK that they have leverage over the EU, and they keep being reminded that it's the EU who has the leverage over them, and so it's not a happy time to be in the UK right now in the Boris Johnson government, of course. So maybe we can come back and look at that a little bit next week too. What else I want to come back and take a look at is these massive cash balances at the Treasury and what that's doing for as we get into the end of the end of the quarter, and how that's screwing with the Fed trying to keep control on the short end of interest rates too. So let's come back to that, talk about that next week.
Quarter end is when we have problems in times of stress.
And we're facing that now. So we're looking towards it. We'll come back and talk about that next week. Guys, have a fantastic weekend. And you've been listening to the HPS Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.